Good afternoon, guys. It's Saturday, October 9th. My name is Dave Coker, and this is Talking About Finance. As we always do, we always start out by looking at the S&P 500 over the past week. And we can see that equity markets overall rebounded. We had a first fall 5% pullback in a year. That was significant. Lots of buyers rushed in, bonds fell. In the U.S., a temporary deal was reached to balance the budget, or to extend the debt ceiling, I should say. So it's sort of a false confidence. The investors went back in because of this, largely because of this. It sort of calmed nerves, and investor confidence was booted. Now, volatility was higher, and we see this due to a surge in energy prices, supply chain disruptions, and labor market shortages. We got it all here in America, right? Now, balancing that out, or at least on the other side, I should say, we see that demand is high. Consumer finances are high, savings are at record levels, and corporate spending has increased. So we're starting to see this balance out, and we're definitely higher prices are here to stay, I should say. We're also seeing the media starting to talk about the Chinese slowdown that we've been mentioning for a couple weeks now with anecdotal data. I got a slide on that a little bit later. So S&P 500 closed up about 80 basis points. 0.8%. It's still up 16.9% year to date. Stunning performance, third year in a row, actually. Oil's approaching $80 a barrel. That's up 64% year to date. My gosh, what a run on oil. The VIX closed last week at 1877, a little bit below the long run mean. It traded on Tuesday, it was up at 23.35. So that's actually interesting. Tensions in the market seem to be easing. Is this the calm before the storm? Or are we setting the stage for another gap up? Who knows? Remember, guys, the code word they keep repeating is TINA. There is no alternative. Well, I think that's rubbish. There's lots of things you can invest in. So make sure you don't get carried away in this market. It's pretty easy if you don't really plan out what you're doing and trade your plan, actually, after you've done it. I would advise you to keep some liquidity in case there's a solid drop, not what we saw this week. And then you can buy in at lower prices. And finally, one word. Dividends. Don't screw around trying to trade. Day trading, swing trading, it ain't no way to live, right? And I've sung the praises of dividends in the past, right, guys? Dividends just get paid every day. Well, discreetly at the end of the month, but they accrue every day. I don't have to do anything to collect dividends, and start to structure your affairs that way. I think you'll find it a lot more pleasant than these fantasies about being some kind of epic trader and you can live off your trading profits. Doesn't happen. We've got the data from the U.S. tax people. No. About 1% of all self-described traders can live off the cash flow from their trading. And of those 1%, they don't persist for any more than 3 years. It's not really a good place to be. All right, let's move on with what we're doing. Now, why is China slowing? We've got a lot of reasons. Here's one that we found. I'm not sure who put this on the Telegram channel, but it's the price of coal. And in renminbi, and my gosh, look at since August. Holy cow, 100% increase. And they're trying to go to cleaner, greener alternatives, but there's an energy crunch globally, and God bless the Chinese consumer. I don't know how they're going to deal with these prices. I'm not sure how we're going to deal with the prices here in the UK when we start to look at gas prices and things like that. Oh, here's an interesting one. And this came off Bloomberg, and one of my friends, she's actually a CTA. She actually works in the commodities. I won't name the institution. And this is funny because, yeah, the good old days when lumber was fun. And I guess her shop made a bucket of money on the way up, and they made a bucket of money on the way down. But look at that run up in lumber. Holy cow. And that's part of the reason why we started to see houses soar. And we'll talk more about that later, but definitely an input price to houses. Here's an interesting one. The reopening. Straight off Bloomberg, we're starting to see suburbanization take place in the States. People are actually leaving the cities, moving out to suburbs in increasing numbers. And in spite of the power that cities have on the national dialogue, look at the share or the percentage of people that are living in cities now compared to back in their heyday in the 30s. It's wild. So people are getting out. And I think I shared with you guys, this is happening in the UK as well. And that's one of the reasons why I'm thinking of dumping my properties in London. There's significant gains there. I've owned them over 20 years. And London's not a good place to live. Let's be honest. It's messy. The pollution levels are through the roof. Crime's very, very high. And we lived in the East End for many years. Wonderful people, wonderful place to live, lots of amenities. We could walk to Tate Modern, for instance. But in general, when we moved out here in the country, it's fantastic. And I always like to point out that my road right outside the property where we live. I can go out there and lie down, take a nap, and more than likely nothing's going to happen. Of course, it could happen, but there's not much traffic there, and we know all the neighbors. So yeah, I'm thinking of dumping the properties in London, and I'm active up north in Liverpool and Hartlepool, and I've got my eye on some properties, so I might be doing something there. I'll see what happens. But in any case, we've seen a huge run up in property prices globally due to all this liquidity sloshing around. And I got some data from JP Morgan, and this went out to my banking clients over the weekend. Actually, this morning it did. And what we're doing here is we're looking at the median price of a flat, and we're dividing it by the median income. And we're looking at different cities. And look at San Francisco and New York, relatively at the low end. As pricey as properties are in San Francisco, I guess incomes are relatively high. Same with New York. London, 13. Tokyo 14, Paris 20. Oh, and then it starts to get odd. I don't know how these Chinese people do it. God bless them. But look at this. I'm going to mispronounce the name, so I'm not even going to try. Guangzhou. Hopefully I did well. If I didn't, be kind. Okay. But yeah, look at Guangzhou. 31, 33 for Shanghai. Beijing, 42, 43 for Shenzhen. And Hong Kong, top of the charts, 46. My gosh, how do you live in those cities? If you're renting, it's pretty wild. Oh, and that title to the slide, go Google The Rent is Too Darn High. He was funny. He ran for president, and that was his party. The Rent is Too High party. I think he ran against Trump the same year Trump ran. I'm not totally sure about that, but interesting one. Now, yeah, I don't like to criticize people, but honestly, I like simple things, and this is supposed to be simple. It's from a group called Financial Simplified. We're laughing about this on the channel. I've got a very simple definition of wealth. And I don't really want to break it down by class, but you're wealthy when your passive income can support your lifestyle. What I mean by that is post-tax, and I even take it a little bit further in my wealth class. It's post-tax, but also you need to generate. If it costs you $10,000 a year to live, you really have to generate about $50,000. That way, post-tax, you can definitely live off the cash flow, and you can thrive because you've got excess liquidity and you can continue to invest. So I don't know who came up with this. This is garbage. I'm with a private bank, and I know they don't look at it this way. I don't think they do. They just want to know you're above the threshold. Okay, and then they've got another threshold up there. It's basically two blocks of people that they worked with. My private bank does not look at things like this. It's pretty strange, but it's simplified, isn't it? All right. Oh yeah, guys, here's something interesting. We're calculating Sharpe ratio, or we're taking a look at Bitcoin rather, and we're comparing the returns on gold, physical gold versus Bitcoin, and there you go. 5 years not looking too good. The 12 months not looking good. It's really interesting compared to Bitcoin. If you take a look at overall, if you look at the returns over the past year, gold is down about 6%. Don't I know it? A good chunk of my retirement money in gold and silver. Bitcoin is up 400%. Don't I know it? A lot of money in Bitcoin. Oh, well, actually, I have Bitcoin worth a lot of money, but I don't have a lot of money invested in Bitcoin, if you know what I mean, because I've been buying it for years. Now, when we take a look at the Sharpe ratio, and of course the Sharpe ratio is measuring excess return that you receive for the volatility of holding a riskier asset. Sharpe ratio stomping. Gold, absolutely incredible. 3.16 for Bitcoin versus a negative 0.57 for gold, for physical gold. It's really wild. Oh, and here we go. Remember, we've talked about the Plan B guy, excellent gentleman, really good guy. He's got the stock to flow model, and now somebody's come up with a stock to FOMO model. And of course, FOMO is fear of missing out. And I don't trade this. I mean, I just buy it and hold on to it, right? I want to see this. This is interesting that he's got this breakdown that way. And since I put the stock to FOMO model in, we've got to talk about stock to flow one more time. And here we are. And of course, Bitcoin's trading roughly 55,000. Nice gap up this week. Check out my blog, FinTech Flash News. We talked about the reasons why. It all comes down to they're not going to outlaw Bitcoin in the States. That was clarified this week. And also there are regulations coming, which both are net positives for Bitcoin. So that's it for this week, guys. Hope you're going to have a real safe and profitable week. Save up your energy, go out and do something awesome. On the weekend, we go clubbing on Friday and Saturday nights. So what you got to do is just relax, take it easy, get ready to hit it hard. Monday morning, you're going to make a lot of money. This market is excellent. Take care, guys. Great chatting with you.